All right, good morning. Hope we all had a good weekend. Last week we saw a broadening of the rally, and again, it's a broadening by our definition, not by the old walls. I write about that in the early look. Don't forget that the Russell was actually down almost a full percent last week. Again, it's back to neutral trend, and I know some of you are looking at that, but a lot of people are bag holding that. And there are a lot of other things that broadened. Consumer staples up over 2%. MLPs up almost 3%. Shipping, best performing ETF in the world on the week, up 12%. Howard's Cannabis, MSOS, up 7%. So again, the process, I'm happy that Portfolio Solutions is showing people the better way. All I had to do is actually show them what's in the account. So that did the job last week, Howard. Good morning.
Yeah. Gotta love cannabis, Keith. So a couple of things for me this morning. First, Domino's, we took it off the long list. It was the best idea long for us coming into this quarter on the macro headwinds, and that was apparent in this quarter. They reported 448 versus 443, but there's a 10-cent gain in there. So I'm going to say they missed by a nickel. The U.S. comps were ahead of estimates. Franchise International missed. The revenues were missed. Essentially, so it's clear the global headwinds are apparent for Domino's. They did show off in the quarter to an extent because they raised the dividend by 24% and raised the buyback. So momentum is definitely slowing, and this will reverse itself next quarter, right? Because comps are slowing in the U.S., so you're going to have the global headwinds persisting, and then you're going to have a slowdown in U.S. sales. So U.S. sales look better this quarter, but that's going to end, call it, in a quarter. So to that point, casual dining traffic was down 5.9% month to date. So 590 basis points slowing month to date. Quick service also slowed down 6.3% for the month to date. And that's a 376 basis point slowdown month over month. And McDonald's, the better burgers, McDonald's didn't last long, Keith. Down 9.2% month to date, and that's still up on a 2-year basis, up 3.6%, but slowing 440 basis on it. 440 basis points. Sorry, trying to get through this quickly on a 2-year basis. And then Starbucks, the disaster continues, down 17% month to date, and that's a 2-year down 310 basis points and slowing month over month. So the Starbucks disaster continues. And then just lastly, I'm going to add Yum China to the long bias list. I know you went through, I know China is quad 1, maybe quad 2, I forget, but if you're a little more bullish on China. So this is a macro call for the most part, because the first half of this year, they have very difficult top one or pod 1 comparisons up. So the comp goes from +8 in the first quarter to +15 in the second quarter. So they're going to be down in the first half. So the China macro looks a little better, but when you boil it down to the pods for Yum China, it's a second half 2024 story for the pods to look better. And that is it for me.
All right. What's going on? All right. Thank you. Biolsi.
Good morning, Keith. I did a scorecard, reviewing the 30 plus companies that presented at the CAGNY conference last week. In my call at 2 today, I'm going to go through the outliers of those companies. And I scored these companies on the drivers, levers, and the ability to beat or miss plan, which is clearly reflected in their PE multiples. But it's the change in those scores, I think, that are going to have a strong influence on the share performance this year. And I think this exercise of scoring it, and we're going to go through it in the call, helps visualize that. So we have several position monitor changes today as part of that review, preparing for the last months of quad 4 and accelerating inflation for consumer staples. Passing through price increases in CPG is akin to like a tanker, right? There's so much inertia, and right now the industry is at 0, so that makes them quite poorly positioned for reaccelerating inflation. So I'm going to go long companies that are the strongest or most improving growth formulas that I think are going to be planned for 2024. So the new longs for me today are Church & Dwight, ticker CHD, Clorox, ticker CLX, and Mondelez, ticker MDLZ. On the flip side, we're going to short the weakest companies, weakest growth formulas with a higher propensity for disappointments, including Conagra, ticker CAG, IFF, International Flavors and Fragrances, Hershey, HSY, JM Smucker, SJM, and Kraft Heinz, KHC. So a bunch of names, and it's too much to kind of go over right now. I'll go over it in the at the call it too.
Well, you know I love getting that many tickers. That's 7 tickers, right? CHD, CLX, MD, and Mondelez, MDLZ, right?
Yes.
CAG, IFF, HSY, and SJM.
Yep.
Nice. Do you know Celsius is now at Jersey Mike's, right there on the front counter?
Yes. They're actually launching in a couple restaurants that, and Howard talked about that too, integrating the threat that poses for Dutch Bros. But yeah, you'll see it, I think, in more of those cooler doors in some of these restaurants.
It's not just cooler doors; it's right in front of the cash register, and no other drink is there.
And so yeah, so that one restaurant, I guess, is doing maybe a little bit different, but that's great. They probably think it's a good add-on.
Coming to your Dunkin' Donuts soon, Keith.
Yeah, I'm checking the channel for you guys. All right. Thank you. Dunkin' Donuts and Jersey Mike's, those would be staples in the hockey community on weekends. All right. We don't live large like everybody else. We just live. All right. Thank you, Jenks.
Good morning, Keith. I got my Dunkin' Donuts right next to me. Wanted to hit on 2 things today. So we do have some additional earnings coming through, but we have Norwegian tomorrow. It's a big one for the cruise lines. And then we have some hotel REITs set to report later this week. And then also there's some online betting or sports betting news that I wanted to hit on. But just ahead of Norwegian, and we're expecting a little bit more of an inline Q4 print. But we would expect their conference call tone and overall outlook to be bullish, especially on the back of what RCL told us last week, sort of setting the record straight on how strong the wave season is, and in particular, looking to that back half bookings cadence. We had talked about the dynamics of near closer in bookings slowing, but that's more optics because there's less to sell, but the back half and really that elongated booking curve shining through and them actually getting really solid pricing. And the bookings backdrop still being very, very positive. So we've actually noted that on Norwegian side, it's a name that we, have on our neutral list. Obviously we have RCL and CCL as top longs in the space, and then in our broader coverage. But Norwegian's been a laggard over the last year plus, and although we still kind of hold that view, data over really the last 3 to 4 weeks has been a lot stronger for them. Not stronger relative to the other two, but just stronger relative to their existing base. So do think that there could be some positive industry read-throughs, and we'll obviously comment on the print tomorrow ahead of their call, but that's sort of the bigger earnings print that we have looking forward to this week. And then on online sports betting, the great state of Illinois is looking to raise tax dollars. Of course they are, and is coming after the gaming industry, this time via sports betting. So middle of last week, Governor Pritzker put out his sort of annual budget, and the expected budget deficit, as it currently stands, would be about $900 million. So he's looking to step on the gas and actually spend more on a year-over-year basis, although they're projecting tax receipts are going to be down. So where do you go to plug the holes? You go to retail sales, gaming, et cetera. Gaming's a perfect one because they've expanded gaming and they continue to adjust the tax rate. So this is part of the risk of doing business on the gaming side in a state like Illinois. We're always very cautious to not model in too much growth. And admittedly, the state on the sports betting side has performed a lot better than our expectations. So back to the main point here, though. So the governor addressed the assembly on Wednesday, but made no mention of sports betting. And then the budget that they released later in the week actually suggests that they're looking to raise an additional $200 million from the sports betting industry by raising the effective tax rate. So right off the top line, raising that tax rate from 15% up to 35%. So obviously that's a big increase. Of course, within their calculations, they assume zero degradation in revenue growth and basically are straight lining the revenue expectation on the growth side across the board. And this, all of a sudden, they're going to have an extra $200 million of tax dollars. Obviously, that's ridiculous, because what will naturally happen if they do in fact get this through is obviously the operators will ratchet back promo spend, they'll ratchet back their marketing, likely have to fire people to obviously reset their expectations on customer LTV to CAC and things like that. So that's the negative on the headline, which is it's obviously going to be a revenue hit, and there would be a shorter term profitability hit. We estimate be about a 5% EBITDA impact to someone like DraftKings. To others, it would be a lot bigger for the year of 2024, and then kind of lessening in the years they're out. So that's the bad, obviously, that there would be a hit there. However, I think there's a potential good here, because at best, this plan for sports betting would only plug a small percentage of really the deficit that they're projecting. So what this potentially does is opens up the state to maybe play ball with the operators and actually legalize online casino, which would be the holy grail. And that's what all these operators are playing for, especially in a mature gaming market like Illinois, where there's a habitual slot player at brick and mortar casinos. Having that online presence would be massive. We see it in Michigan. We see it in Pennsylvania. I've talked about it. There's other states. In the iCasino, I guess, news flow has been a lot more active this season than any of us were expecting. And, maybe this actually sets up the government to, like I had said, play ball with the operators, because I would expect a significant lobby from the likes of DraftKings, Flutter, which owns FanDuel, BetMGM, et cetera, to push back on this. And so maybe it's not 35%, maybe it whittles down to 25%, but I think the operators would in a second say, okay, go to 35%, but give us iCasino and tax that at 35%, because what that would do is you'd go from potentially having EBITDA declines in a market like Illinois to actually close to doubling your EBITDA almost in year two of operation. So it's really interesting. All comes on the heels of DraftKings at the very end of their conference call, what was it, 2 weeks ago, talking about how they think Illinois could be a dark horse this sort of legislative session in terms of legalizing iCasino. So maybe it was them having a sense for Governor Pritzker's plans, which was to come out and talk about raising a tax rate on the sports betting side. But either way, there's been a lot more traction and discussion of Illinois within iCasino and potential legalization. So we think at some point, Illinois is one of the likely ones to go. Illinois, Indiana, New York looks really likely. And then also Maryland is another one that's popped up of late, Ohio eventually as well. But anyway, so obviously I think people maybe would naturally gravitate to the negative, but I think as it relates to the operators, they'll be smart. The impact won't be as bad as people might want to extrapolate here and today. But then the big upside opportunity is obviously on the casino, which comes at a much higher margin, even with a higher tax rate than does sports betting. So interesting things to look at. We'll stay in front of it. I think Illinois is going to be a bigger focus point for us over these next couple of weeks as we watch the headlines and see what comes out of the the negotiation process. But anyway, that's it for us today. No change for me on the stock. I mean, Illinois, like I said, it's 5-6% of revenues at worst. This would be close to an equal amount of hit on the EBITDA for the first year. But again, I think there's more goodies to come from this. There's probably more good than bad.
Got it.
And
All
that's
right. Good. Thank you. McGough?
Hey, man, you hear me okay?
Yep.
Okay, great. So we got a lot to talk about this morning. I'll try and be brief. In our note last night, our Sunday grind, we had 21 call-outs of moves on our idea list and previews for the upcoming week. And as you can guess, our short list continues to get shorter, and we continue to pivot more bullish. So Pool Corp, POOL, that came off of our short list. This is one that pisses me off because we nailed the model with earnings going from $18 down to $13, and the stock still went up. So anyway, that's gone. Upbound, which is the old Rent-A-Center, UPBD, is off of our list. That call worked out great. Stock's down about 60% since we shorted it. There's still probably some consumer credit risk there left, but we're going to book the win and move on. Jeremy is going to touch in a minute on Home Depot and Lowe's. We moved Depot down to our bias list. Lowe's is still a best idea short in their report this week. But I just want to touch on a couple of longs. So on the long side, shocker to you, we added Beyond, BYON, to our best idea long list. This is a name I talked about last week, so I won't go through it in great detail again, but this is basically the company that's going to put Wayfair out of business. This is the old Overstock.com. It's been in business for a real long time. They've got a new CEO who's in place there, Marcus Lemonis, and I'm very proud to say we have both Marcus and Mark Cahotis in the studio on Friday. So Marcus is going to go out and do a non-deal roadshow in about 2 weeks. He's going to hit a number of cities, but if you're a Hedgeye subscriber, you're going to get him first. We actually have him for an hour and a half. You might ask why Mark Cahotis is on this one as well. Mark is the one that actually got him this job. So Mark, in Mark's style, he got the old CEO fired because he was doing a terrible job. And he got Marcus in place here. So we're going to have a great discussion. I'm really looking forward to it. If you're a subscriber, you have access to it. And I'm just like stepping back, like I'm proud of this. This is like our goal with Hedgeye to like bring like Hedgeye quality research to the people. And now if you're a subscriber, and if you're not the hedge fund captain of the universe, you're going to get access before all the long only and the hedge funds are, if you dial in on Friday. So I'm just really looking forward to the call. I'm proud of this one. So it should be a good one.
So that one, just to be crystal clear on this, it's behind the paywall, but anyone who's up to Retail Pro as a subscriber is in, and any institutional account, obviously, that pays it.
That's correct.
All right. Can I come up?
You can come on. I could open it up to Macro Pro.
No, don't do that.
Okay. All right, Jeremy, Jeremy has a heart attack anytime I give away anything.
Unlike some people in this world, I'm still a capitalist, but.
All right, Jam, why don't you take it away on Depot and Lowe's?
Yeah, thanks, Brian. So as Brian noted, some pivots around the home improvement space. We got some important earnings catalysts last week, which weren't as negative for the stocks as as the actual numbers I'd argue should have been. But right, so Lowe's is reporting tomorrow. Home Depot reported last week, and we're taking Home Depot down to our short bias list. So the company guided down comps. They're supposed to be negative again this year, -1%. But if we look at how the company's sort of framing up the industry risk, their framework is actually around continued wallet reversion risk, right? These categories over consuming, pressure from home turnover, and higher rates. So that all makes a lot of sense to us. That's kind of the crux of our call. So they seem to be aware of the problems. The variance would be, we think the industry could be down mid singles to high single digits, and they're thinking only down low single digits. So like they think they gain share, which we would agree with. So they're getting to -1, whereas we think it could be more like down low singles to down mid singles for HD. So we do have a few points in comp variance that gets us below the street. But Home Depot is not over earning on the margin side. So Lowe's is one where we think there's both the comp risk and some margin deleverage risk. And if we look at Home Depot, you kind of need a lot of multiple pressure to get a lot of downside now in the stock, especially given this earnings event just happened. And the rate of change is unlikely to get worse from the sort of current run rate. I don't know if it's going to get a lot better, but the rate of change has been deteriorating. Not sure that's going to be the case here in the coming few quarters. So on the Lowe's side, right, they still need to guide this year on the print tomorrow. We do see that deleverage risk for Lowe's. The visits trends both for Lowe's and Home Depot remain ugly. They're down, like mid-teens year over year on easy compares. So we're not seeing anything that indicates rate of change improving yet, on at least on the visit side. And if it's as it stands today, right, like I think there's this bull case around home turnover picking up, Fed cut, what have you, that's going to really be a bull catalyst for this space. If we were to pick one of them today, Home Depot would probably be the one we'd want to own on like a multi-year basis, a tail basis in terms of their opportunity to win share and drive drive earnings upside. So F&D is one where we pivoted. Didn't really pivot. We shifted it lower just because we've gotten such ugly catalysts on the earnings side, but that stock just keeps going up in terms of the multiple, now trading about 60 times when earnings have come down from over $3 to about $1.90. So anyway, we're getting the earnings catalyst we want. The stocks haven't been behaving as nicely in terms of where those numbers are going, but a little bit less bearish on the home improvement side, with the Lowe's catalyst still to come tomorrow on earnings. And that's all I got.
A lot of people trying to get, or we're along the rate cut bets. And if you bet that in bonds, you got smoked. If you bet it, again, last week, the best performing sector style wasn't even tech. It was consumer staples, right? So that's low beta, higher quality, large cap. Again, lots going on out there, obviously. We're long growth, we're long small cap growth, we're long a lot of different things. But the, the concept of a rate cut, imminent rate cut, we've not been long of, which has been a very good thing to be on the right side of. All right. Thank you. Tom.
Yeah, nothing today, Keith. We exchanged emails yesterday. I'll follow up on some of that a little bit this morning. That's it.
Yeah, my thanks to you guys. My Sundays have never been busier. We've got the full flush going on. You're going to see, the signal strength products launching, I think, this week on signal strength stocks. We're going to have position monitors as single item products that you can buy from each sector head. I go through all these now. I've always gone through them all on my own, but now I actually have to go through them every single Sunday in gruesome detail when the analysts are commenting on them. So it means I actually have to read some words from them, which takes longer than just looking at the numbers. So thanks, Tom, for putting some freaking words in my inbox to color up some of these ideas.
You're welcome.
Yeah. Eventually you have to hear the words and read them. It's just takes me less time to not read words. If I read words, I read books. All right. Thank you, Emily.
I'm all set today too, Keith. Thanks.
Hey, you see the social sorry, I got a bit of a cold here. You see the social media component of what you called a while ago picking up here on, I was watching while I was working. I had PGA golf on, and they kept promoting, I guess, whatever was going to be on next, which is these weight loss drugs may not be good for you segment. I don't know if you saw that yesterday.
Yeah, well, last week, I didn't see the segment, but last week there was I don't know what actually was released, whether it was a peer review journal or a insurance company just talking about it. I have to go back and look, but yeah, last week there was a bit of discussion about the stomach paralysis issue, and which is one of the tricks with Ozempic or Wegovy is that it makes you not want to eat, and in part of the trick with that is for your stomach to just move much more slowly than it otherwise would, and you feel really full. This personally sounds disgusting to me, but that's kind of how it works. And who's really been talking a lot about it has been the insurance companies. Saying this, we're seeing lots of negatives from this drug, and I think that's entirely predictable, right? We had fen that was bad for your heart, and now we've got Wegovy that's bad for your stomach.
Not lost on people in the real world. I'm not going to get into it, but I did let's just say a comprehensive annual physical review, as I do last week, and I got into it with one of the physicians about this, and he's like, dude, just actually, he's the second one to tell me this, and these are guys they're both guys. They don't have to be, but in this case, they were, and both said just let other people do it and see what the after effects are. We don't trust it. Neither of them trust it. They think that it's as I think they say maybe in Good Will Hunting, you're suspect.
Yeah, my doctor said the same thing, and one of the issues that he raised, which is the quality of the production of the drug might be part of the problem. And this is actually true. One of the questions about the COVID vaccines is it the technology itself, or is it the manufacturing quality, which is not crazy. This country is very dependent on imports for drug manufacture, and as things kind of fall apart abroad, that becomes more risky. It's kind of the nature of things.
Yeah. All right. Stay tuned. All I need is a cell signal on Lilly or on Novo. I don't have that yet. People are still chasing those. The machine is still chasing those, which forces people to chase those. Is the correct way to have said that. Apologies for the misstatement this early in the week. I should never say it that way. All right. Steinbauer, are you back?
Hey Keith, no, it's me again this morning. Josh is back tomorrow. We don't got much going on today either. Just wanted to plug our Black Book this Thursday. We're going to be doing kind of a refresh call on the consumer finance, particularly the card lending space, in light of the CFPB ruling on late fees that's around the corner. And just on the heels of this big Discover Capital One deal, we'll be talking the consumer, household financial health, both slants of the K, the up and the down, and what we think the trajectory is for delinquencies and charge-offs, over the next 12 months here. So we're pounding the rock on that, and that's what we got this week.
I had that. I got it twice, not 3 times, but twice, and they're both from institutional clients. Questions, and by the way, we have plenty of institutional clients. To my point here on the call every morning, and asking about the K that Drago keeps talking about. And you say it in passing, but not everybody knows what that is. Can you just take 90 seconds to explain what that is?
Sure. So I guess it's the segment of households that don't have the excess liquidity or asset ownership to benefit from 5% nominal rates, and instead have to pay that cost of credit if they can access it at all. And then on top of that, the segment whose wages are nominally are failing to keep pace, or have failed to keep pace with inflation, and they have therefore been under this sort of cumulative weight of inflation that we've had here over the last the bulk of the last 3 years. And while we have disinflation, that's true, disinflation off of, prices going up less fast, or not as much off of elevated levels, that typically is not a tremendous source of relief for that sort of bottom, slant to the K, and just sort of, colloquially, you can just reduce it to, the haves and the have-nots, right? Or these days, the have-yachts and the have-nots, right? So that's my understanding of it. And I think you're the originator of the term, so you let me know if I got that right.
Yeah, you got that dead right. And I always say the K-shaped economy doesn't stand for Keith. It stands for, and just think of it like, and again, I'm not trying to big time anybody. Use somebody who's just maybe not big time, but has $3 million in savings, right? That would not qualify you, Drago. I mean, you can put that in decile of richness in this country, but you need more than $3 million to get into the top 1%. Let's just say that. Okay. Now let's say that you've worked your butt off for 30 years and you have $3 million in savings, and you're smart enough to put, $3 million in savings into a 4.5% yielding annual, thing. Now all of a sudden you're making, I think the math would be something between 130 and 140 grand in interest that you get a year, right? Now, whereas like 2/3 of the country has zero to earn anything on and is, to Jago's point, paying. So that this is like the K becomes even more skewed as you go further out in time. Now it's great for all of us, most of us on this call, who understand the value of a dollar and where your hard-earned capital should be diversified and placed. I mean, that's the whole point of portfolio solutions. People are like, well, why do you have like 3 different ways to own like, risk-free money? And it's like, are you kidding me? I mean, it's just, in addition to the fact that, we have a lot of RIAs, more RIAs, not family offices. Family offices are allowed to do whatever they damn well please in most cases. But RIAs are like, look, I can't own FDRXX. So, it's like we gave them 3 different ways to do it, right? I mean, it's a material thing, and it's something that's making it worse, not making it better. All right, so that is that. I don't know if you want to color up any commentary I had with some statistics, but
I think you nailed it. I think the qualitative is, perfectly sufficient here. Brings it home.
I think a doctor and or a dentist would be obviously a high-paying job in this country, could work their whole life to have 3 to 5 million clear in savings by the time 30 to 50 years is all said and done. So, again, we're not trying to say anything other than what America's become. All right. Thanks. Let's hear that. You hear Boomer? Boomer just signed off on that message. There we go. Rob's on a client call. Actually, he's getting ready for his pre-IPO book. That's what he's doing. Jay?
Hey, Keith. We're in London this week, but we have nothing today.
You got the look on being in London there, Talbot?
No, I actually didn't travel over with them.
No. So it's actually not we. I was gonna yeah, but Barbara's over there, I think. So that's good. And get a lot of good client feedback there. Friedman.
Hey Keith, you got me today. Just gonna hit on a few position monitor notes that we made over the weekend. We sent that note out this morning, but in terms of the changes that we made, we moved Frontier Fiber, FYBR, to a number 3 active long from number 7. They had a strong earnings report with fiber broadband net adds growing in line with the rest of the year. And their fiber ARPU actually accelerating to close to 5% year-over-year growth, which bodes really well because monetization was a concern that had been cropping up for them. The broadband net adds, the ARPU growth, as well as a strong guide for EBITDA and further ARPU growth in 2024. Stock was up there, so we just moved it up from number 7 to number 3 on our active long list. On top of that, we moved TKO from our number 4 to our number 5 active long, and that was a byproduct of just moving fiber up to number 3. It wasn't a call on the quarter, even though they have earnings this week, so we're keeping it there. We still like TKO there. And then we added Reddit and Sphere to our research bullpens, so doing more research on both of those tickers. Reddit dropped their S1 last week, as we've been talking about, so we'll be going through that and hopefully getting some notes done, getting our model done, and build out our work there on the internet name. But yeah, just a couple of changes on the position monitor. Looking forward to the last week of earnings here.
Good. All right. Lots of tickers floating around in my notebook. They're not floating. They're actually specifically inserted in a position in the notebook that I like to put them in. All right. Thank you. Nick, you on?
Hey Keith, we're all set today. We're just the software team's just working on expanding coverage the next couple of weeks for our position monitor. So that's all I got for you today.
Yeah, I want that beefed up, baby.
Oh yeah.
Show me the meat. Where's it? The beef.
Hopefully we'll get you some tickers here in the next couple of weeks or next week or so.
It's like a cow grazing in Thunder Bay, Ontario, in the middle of February. That list right now. You got to get it beefed up. Show me the beef. All right, Felix.
Hey Keith, let me mention Pinduoduo. So shares are down after the information mentioned a few U.S. politicians looking to ban Temu based on forced labor concerns. Politics will always surround names like Temu, Shein, and TikTok. With Temu, these allegations were made last year and the year before. So I'm not as concerned as the market. Politics take a while to play out. Meanwhile, it's important to note that new Temu users are surging in places like Korea, Japan, UK, and other countries around the world. It's also important to note that Temu still accounts for only a single-digit contribution to PDD's GMV. Another way of saying that is PDD's business remains concentrated in China. So, I remain long PDD, especially after a good Spring Festival data, but it's not a top long at the moment. But I wanted to raise that because it got some media attention. That's it.
Well, Temu, I didn't even know that. I mean, it's so what percentage is it of PDD's revenues and or cash flow?
As a percent of top line, it's probably around high single digits at the moment.
Okay, and is it?
Yeah.
I mean, if you were to pull that out, would it be like a huge IPO or what? I mean, that they're now famous for the Super Bowl ads, or at least for now.
Yeah, I highly doubt they're in a stage to do an IPO because they don't need cash. The parent PDD, parent Pinduoduo Corporation, they have plenty, billions and billions of money to subsidize their overseas arm Temu. So, IPO plans are not in the near future. But at the end of the day, it all comes down to politics. There's a lot of Chinese global tech giants. They wanna IPO in the U.S., but they have to get approval from both China and the U.S. side, and both sides are reluctant. So, that's type of the landscape that we play in today. But I just wanted to say, like, even though Temu is hurting shares, it's important to put this into perspective. It's still a mainland China type of, business that's driving their overall business. Temu subsidy is only single digits in terms of GMV.
Yeah, mainland China is what I was going to ask you about as well. I mean, now we're back-to-back days. That's the beauty of the process. It's fractal in nature, and fractals are beautiful, at least according to me and anybody who likes nature. Like the contours of an ocean line, something like that. The edges of a leaf. So when something undergoes a phase transition, whether it be a caterpillar to a butterfly or China as a factor exposure in my case, that's a big thing, right? It took like over 2 years for this to happen. Now, one, I'll keep you posted. That's the job if it confirms. But if it confirms that we go from mainland Shanghai Composite, Shenzhen, etc., KWeb 2, they're all the same pattern. Goes from bearish, pervasively bearish, as you know, to bullish, and that becomes like an index bet. That's going to really start to change. Like, what you've done really well is you've picked the PDDs and the MNSOs out of the pile when the index bets got sold. And you said this, I mean, if they're long China, they're all along the same stocks. Well, now those stocks, by and large, if this continues to signal bullish trend, even if you don't like them, the machine's going to like them. You see what I'm saying? Alibaba would be the main one.
Yeah, I'm encouraged to hear that, Keith. Hopefully that'll make my job a little bit easier, right? But definitely keep us updated on the signals there. I mean, hopefully China's still, in my opinion, a little bit wobbly, but if it can sustain a rally here, it will be nice to see.
Yeah, that's the right word to use, because it has, like, its quad outlook, or what I call the quad count, is quad 4 here in Q1, then quad 2, which would put the bottom in Q1, quad 2 in Q2, but then back to quad 4 in Q3. So it's going to be a tough one to navigate. Less tough if you just stay signal based and not noise driven. So I think that's going to be obviously something to stay with. And I can see it, like, whether it be through Jenkins, long. These are names you used to model and cover, but LVS or Win, I mean, these signals are all bullish because the China factor component is gone bullish. So after being bearish for a long, long time. So you're going to get more and more on that. Unless you had any other comments on that, I had one other question for you.
No, go ahead.
So Apple on, like, you always say, like, I don't care about Apple going up if the market's going up, but market went vertical last week and Apple went down. I mean, that thing was awful. I mean, on Friday, I don't know if you saw my top 3 things this morning, but I call it the Mag 5 now because you have the terrible 2. The terrible 2 includes Apple and Tesla. Of course, CNBC will never call it the terrible 2, so maybe eventually we'll have to see about that. But this thing, like, what the hell is going on with that stock on Thursday and Friday? I mean, it was 9% of the negative momentum in the S&P 500 on Friday alone.
Yeah, well, it's a good thing we put out a client call updating folks on the latest that we're seeing from Apple on the data side, and data just absolutely looks awful. Again, I would just say it's not just the China story that's hurting Apple. Yes, it's the most major obstacle, but Europe, US, you're not going to see NVIDIA numbers from Apple. Let's put it this way. And they're trading at 30 times for PE on 0 growth. So to me, Apple is a bubble, but nobody says it, right? Everyone's focused on the semiconductors because they just don't go down and the multiples expand. But Apple to me is a big bubble on valuation and on a lot of different other things. But yeah, it's a good thing that you called that out, Keith, because we just hosted a client call last week on this, and this, as you can see by the stock reaction, just keeps going down. That's good for us because we're short.
Yeah, of course it's good for us. That's why I'm talking about it. The Mag 5, instead of Mag 7. The terrible data too, is that, like, when you say it's not just China, you've had this differentiated view on Microsoft PC revival versus Apple, desktop, et cetera, et cetera. Are we getting real-time updates on that, or is that something that you get less frequent? Okay.
Yeah, I have some data sets on that as well that I share with clients. Look, adoption, as long as the AI adoption continues, and then Microsoft and Microsoft's partners puts out AI computers, probably by the summer of this year or so. And I mean, some are already out, but there's more coming. I'm actually more excited on the chip side with what they could do with the ARM-based chips once Microsoft's exclusivity agreement with Qualcomm ends at some point later this year. I mean, that's going to bring up more and more competition for the MacBook, potentially longer term and short term. So yeah, look, again, this is not, I'll say it again, this is not just a China headwind for Apple. Everyone paints it that way, but Apple has a lot on their mind in terms of trying to catch up. One thing they're really behind on is AI. There's been a lot of different type of announcements last couple of weeks on, what Apple could do with their iPhone 16, and then the new software update on 18. I don't know. I mean, all the rumors that have been that's been actually publicly disclosed. We talked about this in January. So they have yet to surprise me on what potentially they could do on AI. In the meantime, Apple is not an AI company. I can tell you 25 other names that are also AI companies. Apple's not one of them.
Well,
at least right.
This is what, like, a major Apple holder, texted me. He already emailed me back, right? Like, when I put it Mag 5 in the top 3, and that's pretty broad institutional distribution to our clients, it's like, well, his answer back is just like, no, it's just because they don't have that AI component in the multiple, and Tesla too. And I'm like, no, they have 0 growth. That's the difference. And they don't have AI, and that's why they have 0 growth. So it's like, it's amazing how people, they'll never, some of these long onlys will never sell their Apple, right? Like, and they'll just go to the next narrative. But this is your research on this name is not only right and very well timed, but it's differentiated, like to the extent that, like, if you're really like a top 1 page holder in Apple and you're not talking objectively about what Felix is calling out here, sorry, man, but you're not doing your job. Like, you're just not, at least the way I define the job. If I was your boss, I wouldn't allow that, right? We can't just like ignore. I think the latest thing in social media is like, well, here's my truth. People like to say now, well, your truth is false, so it doesn't matter. It's just, I think this is just going to be a great experiment in social behavior and cognitive biases and positioning biases, et cetera, et cetera. All right, good. Thank you for that. Paul, Jan?
Yeah, good morning. Yeah, talking about, people's truth on social media. So, some people don't buy other people's truths, obviously, on social media, particularly in the political context, and you get into the election season. So today is finally D-Day on the Supreme Court arguments on the social media cases. These are the Texas and Florida laws that essentially were political censorship statutes that prohibited social media platforms, Twitter, now X at the time, Facebook, et cetera. And, it would apply to Reddit and anybody else. The social media platforms were prohibited from censoring political viewpoints or deplatforming candidates. And again, it all was backed up by the view that social media platforms are run by liberals. They accuse them of that, and therefore they censor conservative political views. So they passed these laws. One court struck down the Florida law. The Texas law has been upheld. They're all stayed pending appeal here to the Supreme Court. But they're going to decide whether or not there's a First Amendment right to essentially engage in political content moderation on these platforms. I think that's what the court ultimately will hold. Where the 3 liberals are going to go on this one. The issue is just, are there going to be at least 2 conservatives who also agree that they perform an editorial function? But part of the problem is that social media platforms publishing the content of others are perceived by some as like quasi common carriers. And you're going to see that more and more for these platforms. And it's not just in the social media context, right? You're going to see it everywhere. Part of Apple's problem, for example, is this belief that, if they got 2 billion users or what have you on their platform, people need access to them. They're a gatekeeper for that. That's part of why they're getting quasi-utility regulation under the Digital Markets Act in Europe. And you're going to see more push for that here. You're seeing state cases to make Google search a utility. You're seeing efforts to basically eventually try to regulate the hyperscale cloud providers as utilities. And all of that has, I think, significant long-term implications because, as we all know, utility regulation tends to soften up your growth multiples because you're kind of regulated like a utility. It's hard to do here because these aren't physical infrastructure companies. They're digital platform companies. So it doesn't quite, it's not the same thing, but nonetheless, what you see is this general global movement in that direction. We're not quite there in the United States, but there's a push here. And I think the next administration, whoever's running the show, there's talk of creating a digital platform agency like the FTC or the FCC dealing just with digital platforms. So you can imagine what kind of cottage industry that's going to create for lawyers and regulators in this country if we go that direction. But you're seeing a trend moving in that direction. We'll see how it plays out. But it does affect, the growth of all of these big platform digital players who are, as we know, like, a huge percentage of the S&P. But, what goes with that benefit goes the burden, and it's just more regulatory pressure. And I think in part, you're seeing some of that play out in the case today. I think you would probably hear some discussion about common carrier concepts applied to social media. Again, I expect that the social media platforms will dodge these laws and ultimately be, their content moderation be acceptable under the First Amendment in exercise of their First Amendment rights. There's spillover effect for companies like a TripAdvisor and a Yelp. They're in this case as well because they're worried if you can do political censorship laws, can you do other things that, affect how they have, recommendations and content selectivity on their platforms with implications for how they, design their platforms for digital advertisers. So all of this is in the mix today. The case is being argued at 10. I expect it to be at least an hour to 2 hour argument. Decision will come out at the end of the second quarter. Again, I expect the social media platforms prevail in this case, but we'll get a better sense about it after hearing the arguments today. So anyway, that's it for me this morning.
I mean, there's so many fish to fry on that. I mean, I personally, like, it doesn't matter what I think personally, but it doesn't bother me. I mean, I think that it creates opportunity for me. I mean, if you're going to be in the business of believing bullshit, then I'm going to take the other side of it and make money trading against you. That's what I'm going to do. Right? I mean, there's a book that I just started reading this weekend called Fossil Future by, I don't know if you know who he is, but by Alex Epstein. And a institutional client sent it to me a little while ago, and it's just like an alternative, to, climate change, like fossil fuels, never. And it's glaring, like if you really look at the differences on some hard-coded facts that I can, that I check myself, right? Like I'm not just going to believe somebody because they write something, but now I have a tool, to do that faster. And then on the tool, and the tool's bullshit some of the times too, ChatGPT in particular, which actually Jim Rickard's going to come out with a book on that topic. But, I know that this is not going to be everybody's favorite commentary, but I don't care. I mean, it's like, if you don't have deltas on the truth versus the facts, how do you make money shorting MPW? Right? If everybody knew the truth from the time the stock was in the high teens, then we wouldn't have made money on it. Right? I mean, it's so, that's what I think about that. I mean, it's the kettle of fish too, Paul, is like the cover of the New York Times on Sunday, yesterday. I know this, hold your breath. My wife's, my wife reads that. But I just look at the front page. And I do that actually for most major media sources. I use it as a contra signal or a kind of behavioral signal, which I think some people know, whether it be the cover pages of Bloomberg, CNBC, New York Times, etc. And it had yesterday a text from a 9-year-old girl. I'm not gonna recap what this thing said, but it literally showed the text, and you can imagine what this was like, and what it's being positioned as, obviously as a major threat to kids, and it's like, to me, that, I mean, that should take on priority over the differences between political biases and feelings. I mean, but again, nobody cares about what I think. It's just on the front of the New York Times now. It's not like it's being just bandied about, in PTA meetings.
Right. The other thing, of course, we've been talking about is these product liability suits against social media, which I know people aren't that focused on, but I think as we get deeper into the year, these bellwether cases and this multi-district litigation, school districts, and you have attorneys general from various states all coming together, and individuals about social media. That kind of stuff could become a bit of a weight as people focus more on the liability risk. There's plenty of evidence about addiction to social media and impacts from people accessing content that's algorithmically driven, though that can be harmful and counterproductive. And, there's going to be just a lot more focus on that too as we get deeper in the year, because that large multi-district litigation is moving forward.
But is there a pecking order to like what topic you go after first? I mean, I personally, maybe it's because I have three daughters. 2 of them right around that age, by the way, 8 and 10 years old. Like sexual predators, like being allowed to do this on, and explicitly targeting them on TikTok and the platforms that they're on. I mean,
that's in the case. That's in the case. That's heart of the case right there.
Oh, it's part of it. Okay.
It's part of it. Absolutely. That stuff's in the case. There's stuff about eating disorders, psychological harm, cyberbullying. The whole idea is that the algorithm just feeds content that tries to keep people glued to the platform. The longer they're on, the stickier it is, the more advertising revenue that's generated. I mean, there's all of this stuff is going to be litigated. There'll be an effort to try to curtail it or dismiss a lot of this, but I already a lot of that has failed. The social media motions to dismiss a lot of that have already failed. So this, like I said, more people are going to pick up on this. This is not congressional testimony. This is actual jury trial stuff that could, theoretically be billions in damages. again, I don't think people are focused on this yet, and we're watching it. But the bellwether cases for litigating the stuff is going to start to move forward. The sexual predator stuff, sexual abuse material, eating disorders, suicide thoughts, all this kind of stuff is going to be in the litigation. Again, that's not testimony before the Hill. This is, actual potential liability risk. So I think people, they're not focused today on it, but I think as we get deeper into the year, it may be something that gets a little bit more attention.
Yeah, we'll move on from this topic. I'm sure people have plenty of feelings on it, but I mean, it's like there's a hierarchy of needs here in terms of like policing certain things. I mean, but if you throw it all into one thing, I mean, you start to deafen some of the severity, like the things that have higher severity. And I don't know, we'll just keep me up on that because, like I said, cover of the New York Times. It's a text about a 9-year-old, I'll say 9-year-old girl, bikini. You can go on and look at it yourself. Suffice to say, it's beyond disgusting and alarming, and I'm not going to keep going about that. All right, JT.
Hey, Keith. So I mentioned Friday that congressional negotiators were potentially going to have a deal over the weekend or even today. I was skeptical, and I remain skeptical. We're going to be back here, I think, for the 5th time, Keith, this week, looking at another CR, another extension of government funding, and or a shutdown this weekend. Remember, we have now March 1st deadline and a March 8th deadline. March 1st, you have 4 bills. March 8th, you have the other 8 appropriations bills. This is supposed to be the easy one. This first one's supposed to be the easy tranche, and it is just tying everybody up there in knots. Complicated by, the Senate comes back today. There's a potential impeachment trial of the Secretary of Homeland Security. House doesn't get back Wednesday. It's an unadulterated mess. So I think what happens is that if we don't have a partial government shutdown this weekend, that we're looking at March 22nd for an extension. Sorry. And then if we don't get to some sort of deal by, remember, April 30th, those 1% across the board cuts go in. That's going to start to be the narrative here soon. I think that this far right element here in the House and some progressives aren't going to play ball. They're not going to play ball with a CR this coming weekend. They're not going to play ball with the rest of the appropriations bills. So either Johnson and Schumer move with the bulk of their conference in a bipartisan way, I guess, or the government shuts down, or we don't have spending bills done by April 30th, and these cuts go into effect. So that's going to be the narrative this week. That's going to be all the talk this week. There's going to be a meeting at the White House tomorrow night, tomorrow afternoon, with what they call the Big Four, with Biden, Johnson, Schumer, and the others. And I don't imagine it'll come out with a deal there. Nothing is going to appease the 2 outlying elements here that seem to be running the show right now. We'll get to foreign aid and the prospects for that later this week, but this is a train wreck coming, Keith. Again, it could be a partial government shutdown. Not many agencies will be affected on this first tranche. The second tranche is the big one. It's the most important one. That's the March 8th one. If we don't get to some sort of CR by at least mid-March, this is going to go back and forth. And I mean, how they're doing this 5 months into the fiscal year is beyond comprehension right now. So this is a dereliction of duty to the nth degree.
I mean, talk about my screens on Consensus Media. I mean, begging for more, like demanding for more, whatever you want to use, however you want to characterize it, for, Ukraine funding is like front center this morning. I mean, that's going, that pressure is rising, not falling. The pressure on the clock, to your point, is rising, not falling. Yep. And the actual debt clock has risen materially, not falling. And these are things that, like, I'll have one of the biggest asset managers in the world will have a call with them at 11 o'clock. We'll talk about it, but it won't be a huge focus because the market hasn't had to deal with it yet. But you take a 1% whack across the board on government spending against tough comps, which we've reviewed in our macro slide deck, you already have very difficult comparisons. So you're likely to show government spending slowing anyway, X the 1% across the board cuts. So that, it's much more imminent, I guess, all of a sudden than what I would have thought before you start talking this morning.
Yeah, it is. And as I said, I'll get more into the 4 and 8 situation tomorrow, because that's going to involve another situation. We're going to bring back the discharge petition term and discuss that a little bit more tomorrow.
Yeah, when I notice it on these screens that I've built, it means that everyone whose first thing in the morning is their political inclinations, which are some of you, in fact, it's many of humans. It's not mine. I'm using these specifically to know like what everybody thinks is the most important thing, like from these media outlets every morning. And like it went back to back on this from Buffett's son, who I've studied Buffett for a long time, but from Buffett's son standing there with Zelensky with, the amount of money he's given him to, what you see this morning in terms of demands. So there's a lot that's happened here in the last, or really since Friday, because it's been a top topic, but it hasn't been the number one or top 3 things that MSM's focused on this morning, but it is today.
That's correct. And I think it's going to be all week. This is going to dominate both of these.
So that's so for those of you that know, we do have to address, obviously that's JT's job. It's and Paul's job. These topics are not easy. It's a lot easier for me to measure and map things with my signal and then quads, but that doesn't mean that these things don't matter, and they particularly matter at particular points in market and cycle time, as Mandelbrot would say. So that's why JT is one of the best at putting something on the calendar with probabilities, which is what I care most about. All right, thanks for joining us. New week, and thanks for joining the call.